Yeah, I feel pretty. I just got a big couch in here too, so I can take
Nice.
naps. It's great. I can sleep in my office. I legitimately have an office. I share it with this guy who's the CEO of Trader Vic's. It's a restaurant company, and he's opening one right next door at my buddy's building. And it used to be a 2-bedroom apartment. They turned it into a commercial office, and so it has a shower and a full kitchen. Now I got a couch. You can just live in my
Wow.
office.
You could. Wow. Yeah, I don't even know where my degrees. I don't even know where my degrees are. They're packed away in a box somewhere, so they're not on the wall.
Well, what the hell do we have them for if you can't put them on the wall, right? I got the CFA one and my master's degree and my undergrad degree. It's like, might as well do something with them.
No, I agree.
I mean, I don't have a resume. I've been on my own since I was 27.
Yeah. And how old are you now?
Ben,
how old are you now, Ben?
What?
How old are you now?
40. I just turned 43 a couple weeks ago.
Wow.
Wow.
Getting
Happy
old,
birthday.
boys.
Happy birthday, belated.
Getting old. And I just found out, or I just read this morning that in 2032, we now have a 2% probability of a big asteroid hitting right for my 50th birthday. Might be it. We got to enjoy the next 7 years, boys.
Enjoy the fireworks. Ben, did you passed all 3 levels of CFA? Good for you.
I did all that stuff when I was young. I went straight to my MBA, and I did the CFA. So I had MBA and CFA done when I was 24, and I was like, well, I'm never taking another test the rest of my life.
I don't blame you.
Yeah, I did 6 years of college, 2 degrees, and CFA, and that was that. All right. What do I want here? So should I reshare this? Jen, did you send the link? All right, we gotta get a few more people up in here.
Yeah, I might as well start though, Ben, because one of the things I'm talking about is Harley Davidson, which was old news now, but I just want to make a point about things that need to be financed. Still disappointing.
Hang on 1 second.
I feel bad I don't have a hat on.
Run, get one.
I can grab one off.
All right, I can turn that off so I don't have to hear that. All right. Need a coffee is what I need.
I think we're live now, Ben.
Yeah, no, I know. I was just waiting for Charlie. He just want to see that pretty face. All right. Let's get the show on the road. Can't believe it's already February 6th. It's gonna be Valentine's Day soon. I'm Ben Bry. This is Charlie Peabody and Bob Morris, Wall Street Beats. We're gonna talk to you about a couple things related to the markets, and Charlie's bearishness will probably come through. So, Charlie, tell us the bad news of the day, buddy.
Well, I'm still on this theme that I've been on since last August, and that is things that need to be financed are going to disappoint. And the latest is Harley Davidson. So things are home builders like Lennar or D.R. Horton. It would be boat companies like Brunswick BC or Polaris PII, Winnebago, and then yesterday Harley Davidson reported. And they missed on earnings. They reported a wider loss of 93 cents versus 66 cent loss expected. Revenues were below expectations, and shipments were way below expectations. So it was an all-around miss. But more importantly, their guidance, which we have up here on the screen now, was very, very disappointing for 25. And the analysts didn't even get the direction right. Analysts had, revenues up, earnings up, and they're guiding down on both revenues and earnings. And more importantly, they're saying that the first half is going to be weaker than the second half. So it just goes to show that affordability is going to continue to be a problem for things that need to be financed. Now, that may change, and Ben, can add to this, but the rate structure now is coming down, in the belly of the curve, that 2 to 5 year part of the curve, which could affect, or help financing costs for a lot of these products. The question is that decline in rates going to be offset by weakness in jobs on Friday? So we'll see. Anyway, I just wanted to mention Harley Davidson within the context of things that need to be financed continue to disappoint. Guidance continues to be weak, particularly for another 6 months. Anyway, next I wanted to mention gold, because I've been a big believer that you should be fading Bitcoin here and buying gold. I've been buying gold since December. We've had a really nice run. Gold is at all-time highs. In nominal terms. But if you look at gold in inflation adjusted terms, it hasn't even come back to the 1980 high that they achieved a couple of decades ago. On an inflation adjusted basis, gold could run another 20% before it got to that 1980 high. And you can see that, the allocation of central bank reserves to gold, because they've been a primary driver of this gold rally, continues to remain below historical lows. So I think gold has another significant run ahead of itself. What I wanted to do today was recommend a gold junior stock called Equinox, EQX. Because the juniors have lagged the seniors. I mean, we've had great runs in Agnico Eagle, AEM, Alamos Gold, AGI, Ashanti, AAU, and those are getting to be pretty rich. So I'm now looking at the juniors to make up some ground. And Equinox is one that's come across my screen as very attractive. It's run by a guy named Ross Beatty, who had run Pan American Silver, and so this, which has been a very successful silver mine down in Mexico, and this is his gold analog. Equinox, I will admit, has been a perennial disappointment for the last 5 years. But the big change is they've got this new mine. It's one of the largest in Canada, called Greenstone, open pit gold mine. It's a very low cost mine. And it's going to take, it's coming, into commercial production right now. This production will increase, their annual mine production from 620,000 towards 1 million over the next couple of years. So it's a big mine. It's one of the largest in Canada. It's a very low cost mine, so it should enhance their margins. And I'm looking for this stock to go from 6 and change on US dollars, towards 12 over the next couple of years. So this is, I think, a double and worth taking a look at. It's Equinox Gold EQX. All right. And then finally, I apologize for running through this so quickly, but finally, next week, we've got some banking conferences. And at these banking conferences, sometimes you'll get mid-quarter updates. I doubt we're going to get significant updates because it's only been a month since they released earnings and gave guidance for the first quarter and full year. But Jen, if you can put up the first chart on NII. So these are my estimates for the big banks in terms of net interest income. Let me back up for a second. In terms of if we do get updates, what they're going to tell you is that expenses are well controlled, credit is benign, all of that's well, discounted in the market. If there are surprises, and I'm not sure there will be, but if there are surprises, it's going to be on the guidance for net interest income and for capital markets. And this first slide shows my net interest income estimates on a quarterly basis for 2025. The one thing I would say is if there are surprises on NII, and I'm, again, it may be too early for them to change guidance at this point, but if there are, it's going to be a disappointment. And the reason it's going to be a disappointment is a couple of things. So there are 4 main variables that I want to talk about that will affect NII forecasts. The first is the nominal level of rates. And as Ben has predicted, we've seen a drop in nominal rates, particularly in that 5 to 10 year part of the curve. And so the ability to reinvest at higher rates is being reduced. And when you look at the forecast that were given back in January for NII, they assumed a much higher reinvestment rate. So as your investment securities from 2 or 3 years ago come due and they get reinvested, the assumption, if you looked at the forward curve back in January, was that they'd be reinvested at 4.7 or 4.8% rates. Now they're going to be reinvested at 4.4 or 4.3 rates. So it's the reinvestment rate is going to be disappointing, I think. The second thing is the shape of the yield curve, which will affect NII. Back in January, when they were giving these forecasts, they were expecting a steeper yield curve because that's what was happening in January. Right now, if you look at the 1 month and 3 month, they're trading at 4.3, 4.33, and the 5 year and the 2 year are trading, at 4.2 or 4 lower than the Fed funds rate. So the yield curve is actually de-inverted, or reinverted, I should say, reinverted rather than steepened, and so that's going to be disappointing. Then if you look at loan demand, we get that on a weekly basis. There's no loan demand. And, particularly in cards, which is your highest yielding, right now there's a seasonal pay down that always happens this time of year. And that's anticipated. But if your highest yielding asset, loan asset is not growing, that makes it tough to grow NII. So as I said, I'm not sure we're going to get updates on NII, but if we do, I think it's going to be a disappointment. Finally, let's switch to capital markets. Jen, if you can put up that last slide. This is my estimates for the first quarter of 25. People have been anticipating capital markets to be pretty robust. The pipelines for deals is very robust, very healthy. But we've gotten off to a very, very slow start in January. Trading will probably be strong. But that's a lower PE type of revenue stream. No one pays up for trading. It's the investment banking that people pay up for. And you can see at the very bottom of this chart, the third one down, people are expecting, mid-single digit growth in investment banking revenue quarter over quarter and mid-teen growth year over year. I will just tell you that in the month of January, because that's the only month we have data for, investment banking activity was very soft. Equity capital markets activity was down 29% year over year. Debt capital markets activity was down 22% year over year. Leveraged loan syndications were down 38% year over year. And M&A, completed M&A was down 16% year over year. So that contrasts very sharply with what the expectations are for the full year. So as I said, I'm not sure we're going to get mid-quarter guidance, but if we do, it's going to be on the revenue side. And if there are surprises, it's likely to be on the negative. So, the bottom line is, these stocks have had a phenomenal January. And I wouldn't be surprised, given this softness, if we get some kind of pullback here in February. So I definitely would not be chasing the banks, and might be, if you're a good trader, might be shorting some of them. So sorry, Ben, I apologize for rambling on.
Is there any in particular that you like short other than the others?
Well, I guess, to me, the capital markets stocks have had the biggest run. And yet January has been very, very soft. So I think that's where you might see some, trading opportunities on the short side, whether you want to go with the secondary names like a Moelis or Evercore or Jefferies, or you want to go with a
Truist, maybe?
Truist. Did you say? Sorry.
Truist, yeah.
That's a regional bank. So that would be a play more on the NII front. And that's what I'm going to be listening for, is any subtleties at these banking conferences saying that, well, maybe NII is not that strong. So Truist would certainly be one. U.S. Bancorp would be another one, and PNC would be a third. So those are the names that you could see some softness here in February, if we get some guidance next week.
All right. Well, I'm with you. I think I've kind of gotten you on the flattener bandwagon. I had to pull you out of that. I had to pull you out of that bond bear steepener mode, and I think you got you with me. And I do think that what about the KRE? That's kind of the easiest way to have a negative call on NII, isn't it? Because those guys are pure plays on it.
Yeah, it is. The KRE is the index worth looking at. And breaking 60 would be very damaging. I don't where is it now, 63 or somewhere around there.
It might even be higher than that, to be honest. Hang on, let me pull it up real quick. Yeah, 65.
65. Okay. So, we could easily trade down to 60. There's supposed to be good support there. So, that's what 8% type of 9% type of decline.
Yeah, I kind of like that. I mean, it's not like a world beater short. Like, I don't know if you guys saw SWKS this morning down a casual 40%, Skyworks, but you can make a little money.
Yeah.
All right, Charlie, you got anything else? You want to talk about gold a little bit?
Gold?
Yeah.
Yeah.
What do you think?
I'm a big believer. I'm more. I was buying in December, January, so now I'm more enjoying the ride. I actually did take some off on my seniors yesterday and started adding to the juniors. So I think there's going to be a catch up trade on the junior miners.
Well, what I was going to say is more along the lines of this. I don't know if you guys saw this news though, but the London Bullion Bank is basically got a line out the door of English people trying to remove their bullion, and they had put a bunch of exports to the U.S., which may be in tariff based, but there is this dynamic of paper versus physical gold, and there's always been this thesis by the gold bugs that if that ever happens, where there's a run, that gold can go vertical, and it's starting to do that right now. The lease rates in London have gone literally vertical.
Hey Ben, this may not be fair, but I'm testing my memory here, but remember in the 20s, or was it in the 30s, that we had the gold domestically and internationally. There was a real demand for gold or shortage of gold, and it created a huge spike in gold. And I'm trying to remember what was behind all of that, but I remember there was a real imbalance where we owned most of the gold, internationally. Physically, and it created a big squeeze internationally. Go back and check your history. I know that there's some parallels going on here.
Yeah, and look, I'll tell you one thing. You guys know I don't like gold miners, but I do think that maybe it's the time for gold miners to have one of those runs. Like, they're historically cheap on cash flow margins right now, and so that you can pick up some beta there. Still hate miners as a business. Don't like gold miners amongst other miners, but I will at least say that if it was ever going to work, right now is the time.
Well, if Bob can't come through with his promises that we're going to have higher oil prices, that could actually help the gold miners, because that's one of their biggest inputs.
Also,
yeah,
that's a great point actually, because it's clearly Trump is going to try and get oil down, whether it's this is a nice segue into Bob, but whether it's through the Saudis or it's lease rates or making banks, end all these crazy laws they can't get capital. I mean, they definitely want to get oil prices down. What do you think about that, Bob?
Well, they definitely do. I mean, and we got to see here what happens with what levers Trump can pull on the international front. It was interesting this morning that Zelensky said that for a peace deal with Russia, it's either a path to NATO or they get nukes. And the U.S. says, well, that ain't happening. Neither one of those are a go. So that sort of, stalls any sort of, I think, peace deal with Russia. And one of the themes was that if Trump were to negotiate a peace agreement between Russia and Ukraine and lifted the restrictions on Russian oil exports, that would help bring down the oil price. So if that's not imminent, then we're looking at, can he do something with the Saudis or OPEC to get them to put more oil in the market to bring down the oil price? But as we've talked about ad nauseum, you're not going to incentivize these E&P companies to drill more. You had ConocoPhillips announce earnings this morning. They said they're going to return $10 billion to shareholders again this year. And that's through dividends, special dividends, and largely share buybacks. So they're saying, look, we're not going to increase spending on drilling. We're not going to increase production. We're going to continue to do what shareholders want us to do, and has provided the best returns. And that's to give a significant amount of our cash flow back to the shareholders. So on that point, it's still a question as to how Trump goes about bringing down oil prices, but clearly he wants them lower than where they are today. And, there may be some bilateral agreements in getting that done with Europe or with the Saudis, OPEC. We have yet to see how that plays out. But in the meantime, I've been buying some Kinder Morgan here this morning. And what's interesting is you look at these natural gas pipeline stocks that all have very high dividend yields. They kind of creeped up ahead of Trump's inauguration, and they were very strong. And then what happened was this whole DeepSeek event that occurred on the 27th hammered all the pipeline companies along with NVIDIA and a lot of the chip companies. And if you look at the pipeline companies we like, Williams, we've got a full position in. It sort of recovered a little bit, but not all of that hit that they took on the 27th following the DeepSeek announcement. Energy Transfer has pretty much recovered that hit that they took on the 27th, but Kinder Morgan's lagged. And it's interesting. I was looking at a chart of over the last month of Kinder Morgan versus NVIDIA. And the charts are somewhat similar, although NVIDIA's actually recovered a little bit more than Kinder Morgan. So I'm not sure why Kinder Morgan's lagged the other pipeline companies on that hit that they all took on the 27th, but they did report earnings on the 22nd of January. It was fine. They increased the dividend 2%. Williams last week increased their dividend 3%. So these are dividend growth companies that pay very good dividends. Again, Kinder Morgan's at 4.2%. And on this pullback, I'm still, building toward a full position. I came on the show about 3 weeks ago and said, look, we've got a full position in Williams, but now we're building positions in Energy Transfer and Kinder Morgan. And on this pullback, I'm adding to Kinder Morgan here this morning.
Yep. Yeah, I thought ET was a buy that day when we had the DeepSeek thing. It seemed a little aggressive.
Yeah, we added a little bit then, and this morning I'm adding Kinder Morgan. But absolutely, those are, and we're still going to have these data center build out, despite what's going on with DeepSeek, and we still don't know the full answer. You're still going to need a lot of natural gas for energy to power these data centers, and this whole Stargate project and all this going on. That's not going to get derailed. So, in my opinion, and look, Kinder Morgan, they're the largest natural gas transporter in the U.S. They transport 40% of the natural gas production in the U.S. And, 80, 90% of their business is very steady, fee-based or take-or-pay type business. So it's a very strong business.
Yeah. I mean, you're not going to get any argument on me. You know how I feel about pipelines.
Bob, ET Energy Transfer is being, cited quite a bit on the popular business news shows these days. So
yes.
Clearly the broader portfolio manager group is into that name.
Yeah, and we like that name too. Look, the dividend on it is 6.2%, but there you've got a K1. That's the difference, whereas, Kinder Morgan, Williams, or C Corps. So depending on how you want to play that. But yeah, both of them are very good names. I may add a little bit of ET here this morning too. It's just recovered more than Kinder Morgan. So both names I'm looking to add to my positions on. Williams, we last summer we bought that. We're up more than 35% on that name. In November, we came out and raised our price target to 64. The stock's at 57. So we still love that name and are holding on to that name, but we've got a full position there already.
And CNQ reports soon, and you think there's a chance of a dividend increase? Is that right?
Well, at some point, we'll see. Oftentimes, in the past, they've increased the dividend with first quarter. The thing is, they increased it twice last year. And so they most recently increased it in, was it third or fourth quarter? I think it was the fourth quarter. So will they increase it again this quickly? I don't know if they'll do it the first quarter, but at some point they will increase the dividend this year. There's no question about it. Whether we get it first quarter or later, we'll see here. They're paying down debt from some acquisitions. So it may be second quarter. I don't know. But historically, you usually get it in first quarter. The only caveat there is they increased it twice last year.
Okay.
But we'll get a dividend increase this year. There's no question about that.
And if Ben is right on his, rate forecast, and who knows whether Ben's ever going to be right, in the future.
Ben's been killing it here with some of these trades. He's been making money shorting Apple, and he's been all over the board with these iron condor spreads, and I don't know.
Yo, that iron condor is true though. Look, we're just sitting there and doing nothing. I mean, the dominant trading strategy, if you want to trade, is short it about right now, maybe Friday. Then we get some Trump headline or some kind of thing, get a dump over the weekend, buy it on Monday, grind it up like that. But, if you're the lazy man, the short iron condor's been great. You just sit in the rain for 3 months.
Ben, what's your best rate trade right now? Is it SOFR or is it TLT? What is your best rate trade?
I bought a lot of TLT calls. And I haven't owned the long end in a long time. And then I think, yeah, I can touch that real quick. Just so everyone knows, I prefer to trade SOFRs in the futures or market. It's a little more anchored, and you can use a ton of leverage. So it's not like whatever. But not everybody trades SOFR, but this is the first time where I've been in the long end for a long time, and I've had a pretty steady view that like we're going to flatten, and then eventually I think rates will come down. But it just seems like the order of operations is that we flatten first. And it's just kind of taking off that 100 basis points of cuts that the Fed did. Like they really didn't need to do that. And so then it's kind of artificially steepened, and it's retaking it, right? So what was the 10-year got to 480, and right now we're at 443. It was 441 yesterday because of the QRA mix. Scott Bessant came out and said, hey, we're going to keep going with the bill issuance like Yellen, and I think there was some anticipation that the supply would come on the long end. I think CTAs had been short because they had been working for a little while. And then there's some lazy narratives out there that inflation is going to come from tariffs and deportations and stuff. And it's, I think the growth slowdown is the more important thing to be thinking about right now than inflation. And especially if we're going to be cutting the deficit.
That's an important point, because when I talk to fixed income investors and we talk about the term premium, there are three variables that they assess. One is inflation, the other is the Treasury terming out the debt by the Treasury, and the third is Trump's tariff and deportation policies and anything that would be considered inflationary. And inflation seems to be the least of the concerns of these fixed income guys, whereas Trump policies and the effects of DOGE are the biggest variable that they think.
Definitely.
And so I'm guessing that what we've saw in the last 48 hours or 72 hours of this rally in long end is, confidence that DOGE is going to make some progress. That seems to be what
I think it's that, and I think it's the funding mix. I think the funding mix, there was some anticipation they might term it out, but I think here to wrap this thing up, since you're on the one end banks guy and Bob's on the other end energy guy, they clearly want to get inflation beaten rates down. And I think their plan is as follows. Do whatever they can. Bob just talked about it with energy. We don't know exactly how it will play out, but they're going to do whatever they can, whether it's the Saudis, it's leases, whatever. So the energy thing's one. And then taking the pain as early as possible in the economy to, as far away from the midterms. So aggressively cutting, and then, focusing on the long end of the curve, taking the term premium out. The longer the Fed stays up here, the worse it's going to be. You know what I mean? Like they're gonna overstay their welcome, as they always do, and then all of a sudden they're gonna be like, "We got a 75 basis point cut." I just know it's coming. Like I just remember 07, 09, and I remember it was like January of 08. All of a sudden it was like, "Oh, there's an emergency 75 in your face. We'll have one of those. You can take that to the bank." So I just think that they're in the process of trying to get the dollar strong. That will lead to lower rates, and then deregulation, lower energy. Like that's their plan. Whether they execute or not, that's to remain to be seen. But I think that's very clearly their plan is now starting to, I think people can realize what they're trying to do. I guess is the way I put it.
And
so to wrap it up, energy remains interesting, but you do have oil's given back a lot, right, Bob? I mean, we've had pretty decent reduction on the short end of the curve.
Yeah, we're at almost $71 a barrel, and Trump wants it a little bit. He wants it with a 6 handle on it. So yeah, and energy is underperforming today, but we'll see. It's had a little bit of a pullback, but that's fine.
Yeah, I mean, I'm looking at the curve, and even 2-year oil is down about $2 or $3 since a month ago, and the front's down about 5-4. So you've had a little bit of a reduction there, but I don't know.
And the curve's in backwardation. You look at the curve. You go out almost a year from now, and we've got we're down around 67.
Yeah,
64 actually.
November was 67. I didn't see where Feb is, but yeah, we're in backwardation on the curve. So,
you're right. You're right. 1 year out is 66, 67. 2 years out is at 64. But anyway, the point is if they could get $50 to $60 oil, that would have a large implications on it. Although they can't tax your C&Q, buddy, let's that was a good idea. Bob told us to buy C&Q, and the day Monday actually it was with the tariff stuff,
pullback, yeah.
and down at 29 and change, and we've had a couple bucks since then. It was a good trade so far. And so, go ahead.
No, I was going to say we'll start to get earnings next week from all the E&Ps. I believe over the next 3 weeks, then we'll start to hear. We've had Chevron, Exxon, and Conoco so far, but then all the E&Ps we'll start to hear from. So,
yeah. All right. Well, we'll give you more updates on that as we come back. I think Charlie had to leave. He was going to a conference to talk to some banks, and I'm out of here as well. So have a good day. And Ben Bryce, Bob Morris, come visit us at Wall Street Beats, and see you later. All right, guys, I got to run. Talk to you later.
all right.